Good morning, everyone. Welcome to Bishop Fleming's Spring Budget Update. For those that don't know me, I'm Andrew Brown. I head up the tax function here. And I've got a great team of experts that are going to talk you through the various changes announced yesterday. If you've got questions, please publish them and we'll try and do as many as we can at the end. Before I start, I don't know about the rest of you, I'm really looking forward to the 12th of April. My best friend, it's his birthday, and on that day we've already organised a game of golf followed by a beer outside. No doubt it'll be raining, but anyway. Talking of hospitality, I'm going to introduce you to our first speaker now, which is Wendy Andrews, who is head of our VAT team, and she's going to talk you through some of the announcements yesterday.
Thanks very much, Andrew, and good morning, everyone. Yes, as everyone is aware, the hospitality sector, so pubs, restaurants, cafes, hotels, etc., along with retail, has been particularly badly hit during the pandemic, often having to close at short notice and for long periods of time. So there were some announcements in the budget which will be a particular help to hospitality businesses. First of all, you'll have seen that the Coronavirus Job Retention Scheme, or furlough, which involves government payments to people unable to work as a result of lockdowns, etc., was due to end on the 30th of April 2021, but it's now been extended until the 30th of September this year. The amount received by employees on furlough will continue to be 80% of salary, up to £2,500 a month. But from the 1st of July, employers will be required to make a 10% contribution, and in August and September, they'll need to make a 20% contribution. On the basis that lockdown is due to end during June, this should allow for a gradual return to work as affected businesses gradually start trading again. In addition, specifically for hospitality businesses, the business rates holiday, which had been due to end on the 31st of March, has now been extended by another 3 months to the 30th of June. And then a further 2/3 discount to business rates for the following 6 months and up to the end of the calendar year, up to a maximum of £2 million for closed businesses. And then thirdly, the 5% reduced VAT rate for hospitality, accommodation and attractions, which was due to end on the 31st of March this year, has also been extended until the 30th of September at 5%. And then there'll be a new 12.5% VAT rate for those supplies until the 31st of March 2022. So supplies of hospitality won't return to the 20% VAT rate until the 1st of April 2022. This is obviously a very welcome extension of that reduced VAT rate, although with 3 different VAT rates in force inside a single year, it's going to be really important to make sure VAT accounting systems keep up with the changes, especially in terms of things like advance payments, etc. There were also some VAT changes, some other VAT changes in the budget, which will have a wider application apart from hospitality. You'll remember that last year, businesses were allowed to defer the VAT payments, which became due in March, April and May. And those payments were initially due to be paid, deferred VAT payments due to be paid to HMRC on the 31st of March this year. The government had already announced that it would now be possible to make those payments in instalments, which was very welcome. But there is a hidden comment in the budget information, which says that any business which by the 30th of June this year has not either repaid their deferred VAT to HMRC or agreed a payment schedule with HMRC, there will be a 5% penalty on any VAT outstanding that hasn't been either deferred or paid. So that's a bit of a hidden charge which could arise and just stresses the real importance, if you aren't able to repay your deferred VAT, of agreeing some payment terms with HMRC. There was also a rather complicated announcement about a new penalty regime which will apply to both VAT and income tax self-assessment. It'll be introduced from the 1st of April next year for VAT and over the following couple of years for income tax. It includes several different factors, including a points-based system of penalties for the late filing of VAT and income tax returns, and then a two-stage penalty process for late payment and also an interest charge. So quite a lot of detail in there, which will be worth looking at the detailed legislation to see exactly how that's going to work in practice, and also obviously how HMRC are planning to implement it. And then my final point on VAT is on making tax digital. An announcement yesterday just confirming really what we already knew, that from the 1st of April 2022, all VAT registered businesses, including those below the VAT registration threshold, will need to use making tax digital for VAT. So that means even if your turnover is below 85,000, you will need to submit your VAT return using software, and you'll need to have fully digital records for your VAT accounting. Thanks.
Thank you, Wendy. I think actually the hospitality sector and retail, the VAT change, we're keeping the 5% for the summer is great, and the business rates is good, and then extended furlough. So hopefully that will help that trade recover. I have to say, speaking to a couple of hotel groups in this week, their bookings are looking really strong for the summer. So I'm really hoping they have a really strong summer so they can get back on track. Now, looking at other measures that the government brought in yesterday, Chris Walklett's going to talk you through many of those, including the super deduction. Chris is tax partner. He heads up our international and our innovation team. So over to you, Chris.
Thank you, Andrew, and good morning, everybody. Well, Andrew's referenced the super deduction, which has come under the heading of the investment-led recovery that the Chancellor talked about as one of his 3 planks to take us forward out of the pandemic. I will lead with the super deduction because that was one of the biggest announcements yesterday. In simple terms, if you are a business that is spending, say, £10 million on plant and machinery, you'd hope that over time you're going to get a corporate tax deduction for that. It would be over a number of years, and at current rates, that would have saved you 1.9 million of tax, but of course we're going up to 25%, which Mark will come on to later. So that's a 19% profit shelter enjoyed over time. Yesterday's announcement was saying, let's take that same £10 million of qualifying spend and turn it into 13 million in terms of a tax deduction and give that to you instantly. If you've seen any of the commentary, you'll have seen numbers that basically say for every pound invested, you're getting 25p back. And the maths there is that if you spent 13 million, if you spent 10 million, but you've got 13 million of tax shelter at 19%, it's about 2.5 million pounds. This is for plant and machinery that you've used in the trade, or you're going to use in the trade. It excludes things like cars, assets that you're going to buy to lease out. I've already seen a question flow through in terms of leasehold improvements. Leasehold improvements, if that improvement cost is a plant and machinery item, then yes, it really would depend on what the nature of that leasehold improvement is. If your asset was plant and machinery but would have qualified for the reduced rate, the 6% special writing down allowances, then it's a 50% step up, not the 130%. So some planning points start to come out of this as we look post 1st of April when this comes in, because this measure is for qualifying expenditure incurred after the 1st of April 21 up to and including March 23. So from the 1st of April, we're starting to think, right, let's see what we can get into the super deduction. Then if it doesn't go into the super deduction and it was at the lower rate, let's see if we can get it into what I would call the super 50 as opposed to the super 130. Then think about annual investment allowances. So there's going to be a number of ways we're going to prioritise the way that your expenditure goes through your tax comp to maximise your accessing these various allowances. Beware disposals, because if you dispose of these assets that you've claimed a super deduction on, you're going to get an equivalent super clawback. Another thing to watch, an interesting one for you with, looking at large levels of expenditure, and for you accountants out there, and I know there's some of you on this session today, you're likely to get a massive deferred tax adjustment on your accounts because you will have immediately had tax relief for material amounts of money. As that investment is depreciated through your accounts, you're driving non-tax deductible expense through your accounts. The net tax result is the same, you've had extra tax relief, but there is going to be a material adjustment in deferred tax there. Moving on, R&D tax credits. There were no specific changes to R&D tax credits yesterday, but we've already had one consultation complete on broadening the amount of expenditure that might qualify for R&D tax credits. And yesterday they announced an additional consultation. The government is keen to raise the total of investment in research and development in this country to about 2.4% of GDP by 2027. In the budget statement, the Chancellor made very positive noises about how strong the knowledge sector, the knowledge intensive, the IP innovation sector is in the UK. He quoted figures saying that we host 4 of the world's top 20 universities, and I quote, "We have more Nobel laureates than any nation apart from the United States." That's all great rhetoric. I fully support us trying to move towards a more knowledge-based economy, but the sad truth is, when the stock markets crashed last year, the recovery was led in other countries because they had better innovative companies quoted on their stock markets. The FTSE lagged, and the FTSE lagged in its recovery largely because we are lagging in terms of proper commercialisation of IP in the UK. The good thing about the consultation is very much aimed about improving the regime. There is no hint whatsoever that R&D tax credits will disappear. So if you're in investment mode spurred on by the economy and you're not currently claiming R&D tax credits, now might be the time to start thinking about it, but caution, at the same time they're looking to improve the regime, they're also cracking down on abuse and anti-avoidance. Recently, we heard of some business owners actually going to jail for fraud because they created a carousel fraud with R&D tax credits. If you're investing in this plant and machinery that's going to attract this super deduction, or start looking to invest in innovation and claim those R&D tax credits, where are you going to get the money from? Well, hopefully there's some business out there that are doing very well and are very strong. Others of you may have been claiming government support under either the CBILS or the business bounce back loan provisions. Both of those end on the 31st of March this year. Bounce back loans are great, small loans, easy to get into, fixed rate of 2.5% interest. The CBILS loan was made slightly more flexible more recently when they changed the goalpost in terms of your reference accounting period to look as to whether you would qualify. But as I say, both of those are coming to the end. They will be replaced from the 6th of April until the 31st of December 21 with a recovery loan. The interest will not be underwritten by the government, nor will there be a deferment on payment. You'll have to pay the interest, you'll have to start repaying the loan. Normal banking lending criteria will apply, but these are up to 10 million. These are loans for up to 10 million over a 6-year period. And if you've already claimed CBILS or bounce back, you will still be able to claim. And if you haven't claimed relief under those old schemes, you will be able to claim. So a great extension of the support mechanism that will help us ease out of lockdown and not give us a cliff edge. So in terms of planning, think about your refinancing. It might help your working capital position as you ramp your business up as the economy picks up. Few valuation related items here. Be careful that if you're taking this borrowing, it will depress the equity value in your business because you are taking more debt onto your balance sheet. But you might be able to time that nicely with an application for EMI share options, because if you're refinancing and that has a temporary depressing effect on your equity value, that would be a good time to agree a share option value with HMRC. And of course, just to reiterate, we're sucking in funding in here, which you could then plough into your plant and machinery investment and claim that super deduction on. So flexible finance to invest super tax deductions. What's not to like, as long as you're borrowing responsibly? And just a final point under the heading of recovery, investment led is not investment delivered unless we've got the people to deliver it. And I'm pleased to say that trainees and apprenticeships have been supported yet again in the budget. And the government's going to extend and increase the payments made to employers who hire new apprentices. We hire apprentices and school leavers. Fantastic way of energising your organisation, bringing in the talent that you can grow for the future. And from the 1st of April this year to the 30th of September, employers that hire them will now get £3,000 per new hire, compared with £1,500 under the old regime. So the planning point here, apprentices are critical to the business and economy. So review your resourcing strategy. And if you've not previously embraced apprentices as a route to resource, possibly engage with your local LEP. They all have apprentice programs where you can learn more and explore how apprentices can benefit your business. Andrew, I'll hand back to you.
Thank you, Chris. The super deduction was certainly a surprise, and I think, as Chris says there, that combination of being able to claim that 130% and the new finance available should hopefully help us kickstart, combined with that apprenticeship, which is also really good. I think the new money is really important because actually, if you look at insolvency situations, it tends to come when you start to trade again, and you overtrade and you run out of cash. So planning for that and planning for your finance on a growth is really important. I've seen there's a couple of questions. Well, there's this one question on capital gains tax. I think I'll deal with that one because I suspect a lot of you were wondering what happened. So there's a lot of speculation, obviously, about capital gains tax going up. The Chancellor yesterday mentioned absolutely nothing on it. He didn't say, I'm not going to do it. He didn't say, I'm going to do it. Interestingly, he did say that he wanted to be honest and tell you everything that's going to happen. So you might read into that, maybe we're okay. There is various consultation going on. I think Adele will cover that a little bit later. And I think the only answer I can say on that is you're safe for now, but it's clearly potentially on the agenda. So I suspect, would they change it in November? Not normally. So probably you're safe for the next 12 months. Anyway, another announcement yesterday was over housing and self-employed. I'll introduce you now to Adele Clapp, who's a senior manager in our private client team, who will talk you through those new incentives.
Thanks, Andrew, and hello to everyone. So looking at housing first, it was announced yesterday that the SDLT nil rate band will remain at £500,000 until 30th of June, which would be good news for anyone with house purchasing that's currently going through. It's going to decrease to £250,000 from 1st of July, and then it will return to £125,000 from the 1st of October. The government also announced that they're going to back 95% mortgages on properties worth up to £600,000. This isn't solely for first-time buyers, and it's likely the products would be available from April from the bigger banks initially. A couple of smaller points on housing. From 1st of April, there's going to be a stamp duty land tax surcharge of 2% for non-UK residents who are purchasing residential property in England and Northern Ireland. And also, where companies hold residential property that's worth more than £500,000, the 8-head rates will rise by 0.5% from 1st of April. So turning to the support announced for the self-employed, the Chancellor announced 2 further grant payments yesterday, and these will be available to all self-employed individuals who filed their 2019-20 tax return by midnight on the 2nd of March. The 4th grant covers the period from February to April and can be claimed in April. This is worth up to 80% of your trading profits averaged over a 3-month period, up to a maximum of £7,500. Like the 3rd grant, the taxpayer must declare that they have suffered a significant drop in trading profits, but HMRC haven't said what they would consider to be a significant drop. So what you have to consider is your individual and wider business circumstances when you make that assessment. Okay, so the 5th grant is more complicated and covers the period from May to September. This can be claimed from July, and it depends on the loss of turnover rather than profits. So if turnover has fallen by 30% or more, the grant will follow the previous pattern, and you can claim up to 80% of your average trading profits up to £7,500. If your turnover has fallen by less than 30%, the grant will be based on 30% of average profits capped at £2,850. All grants are going to be taxable in the year of receipt, so when you come to do your tax returns, that's quite useful to know. Likewise, any workers who work through their own personal service companies at the moment and have been paid a mixture of salary and dividends are still not covered by any of support measures that are in place. So that's just something to bear in mind. This then leads on to the introduction of the off-payroll worker rules in the private sector from April 2021. Obviously, this was pushed back before, and despite widespread concerns over the complexities of the rules and determining employment status, HMRC are still going ahead with these rules, and they'll be in place from 6th of April. We're running a recap on these rules in a separate webinar later on in March. However, the only real changes announced in this budget is to address an accidental widening of the conditions where the intermediary is a company, and to also include the intermediary in a requirement to provide information to the end client. So the end client will be in a position to know if these rules will apply or not. Finally, the provisions relating to the provision of fraudulent information has now been extended to relate to any UK-based party in the labour supply chain. Okay, thank you. Andrew, mute.
Sorry, that happened, didn't it? Thank you, Adele. I'll move on quite quickly after that error. So the one tax that did go up was corporation tax. And here to explain the various changes actually in corporation tax is Mark Richton, who's a senior tax manager in our business team. Mark.
Thank you, Andrew. One of the biggest headline grabbing announcements was the increase to the corporation tax main rate. When Rishi Sunak stood up last year to deliver the 2020 budget, the CT rate was set to reduce to 17%. However, on that very same day, the 11th of March 2020, the World Health Organization declared coronavirus a pandemic, and it has drastically changed all of our lives since. So just prior to last year's budget, the corporation tax was set to be 17%, and yesterday's budget increased it to 25% from April 2023. What a difference 12 months can make. But there was not just an increase to the main rate, there was also an additional corporation tax rate announced, the small profits rate. And the government are reverting back to the corporation tax system we had that was discontinued in April 2015 because marginal relief is also back. So from April 2023, companies with annual taxable profits of £50,000 or less will be subject to the new small profits corporation tax rate of 19%. Companies with taxable profits in excess of £250,000 will be subject to the main corporation tax rate of 25%, and companies with profits between £50,000 and £250,000 will pay at 25% less marginal relief. There are also additional knock-on effects of the increase in the corporation tax main rate, one of which is the need to revisit salary versus dividend remuneration strategies. It was only 5 years ago that an owner-manager could extract over £40,000 a year through dividends without paying any income tax or national insurance at all. This meant profit extraction tended to lean towards dividends as the preferred method compared to salary, but incremental changes to dividend tax rates over the last few years has reduced their tax advantage. Now, with the corporation tax rate set to increase to 25% in April 2023, and from some very crude calculations for additional rate taxpayers I did last night, the tax benefits of taking dividends over salary have all but extinguished. There will of course be differences in circumstances for all taxpayers, and it may be worth revisiting remuneration strategies over the next few years. Another effect outlined in the detailed notes accompanying the budget were changes to the impact of associated companies. The last time a corporation tax return included marginal relief, the thresholds were reduced by dividing by the number of associated companies. From April 2015, when marginal relief no longer applied, the rules changed to a significantly simpler system of looking only at 51% owned group companies. This is especially important when determining whether a company is large or very large for quarterly instalment payments. With the reintroduction of marginal relief, the associated company definition is also back. This has wider and potentially more immediate implications for corporation tax. There's been no confirmation of whether the associated company rules are being reintroduced in line with marginal relief in 2023 or they're going to come in earlier. But as it means a higher number of companies are to be included in the calculation, companies previously outside the requirement to pay under large or very large quarterly instalment regime could now have to pay their corporation tax earlier than anticipated. The main corporation tax rate increase, or having to pay tax earlier through the quarterly instalment regime, obviously only affects companies that generate taxable profits. But what if a business isn't profit making? The government, as they did in previous times of economic crisis in 1991 and back in 2008, have temporarily extended the period a company or unincorporated business can carry back trading losses for a repayment of taxes paid in earlier years. The extension means losses generated in periods ending between April 2020 and March 2022 for companies, and the tax years 2021 and 21-22 for unincorporated businesses can now be carried back 3 years rather than just 12 months. There are, however, restrictions, and to claim loss relief beyond 12 months, the total loss available is limited to £2 million per group and must be offset against profits of the same trade. One way a company could have an accounting profit but generate a tax loss is through the use of capital allowances and the annual investment allowance. Although not quite as exciting as the new super deductions, annual investment allowance is still available, and it permits a business to deduct the total amount of qualifying capital expenditure up to an annual limit from taxable profits. We have known for some time that the annual investment allowance will remain at £1 million until the 1st of January 2022, when it will reduce back to £200,000. There will be transitional rules, and there's a question I think about the cliff edge as well, and it covers the reduction to the £200,000 for accounting periods that straddle the 1st of January, and they are notoriously complicated depending on the period end and when qualifying expenditure is incurred. It's important to be aware of the transitional rules because for a March year end, for example, if you're buying an £800,000 piece of equipment on the 31st of December 2021, you could be able to claim £750,000 in tax deduction in that year. If you bought that piece of equipment just 1 day later, the immediate tax deduction is only £50,000. Now, something totally different for me to finish with, digital platform regulation. This is all linked to HMRC's prevention of tax evasion, and you can tell who HMRC are aiming this at because in their own words, it includes income generated from apps that facilitate taxi and private hire services, food delivery services, and the letting of short-term accommodation. Although HMRC already has some power to access information from these digital platforms, the announced regulations yesterday will require certain platforms to report information to HMRC about the income of sellers of services on their platforms. The regulations are still subject to consultation and are not expected to come into force until January 2023 at the earliest. Back to you, Andrew.
Thank you, Mark. Yes, and I see there's a question about why didn't he bring in the change to 25% over a number of years. I suspect he wanted to keep it low whilst we're in recovery. I'm not overly surprised at the rate being 25, but I thought he would bring it in over a number of years, but obviously he's decided to keep it low for a couple of years and then bring it in one go. As Mark said, there's actually quite a lot of planning, and the change on when you have to pay your tax could catch quite a few. And generally, if you get caught the first year, you're like paying 2 lots of tax in a 12-month period, so it can be quite a problem, and you need to plan for that. Now, yesterday, the Chancellor had a bit of a Disney theme, Frozen. Everything was frozen. So, as it's her favourite film, I'll let Adele talk you through Frozen.
To be fair, by now, Angie should really let it go. But as he's already mentioned, after widespread speculation, we were waiting to hear about changes to the capital gains tax system and inheritance tax as well. As he's mentioned, there were no announcements at all for either of those taxes, and there was also nothing regarding the introduction of a possible wealth tax. There have been a number of reports in this area. So you've had the Office of Tax Simplification CGT report. We're waiting for the second instalment of that to come out still. And we also had the House of Commons Tax After Coronavirus report, all of which said that there should be substantial reforms in this area and came up with a number of different suggestions or recommendations. Having said that, at the moment, as we've already mentioned, the Chancellor is instead looking to raise revenue by freezing the tax thresholds. So the VAT registration threshold, so Wendy doesn't get annoyed with me for forgetting it, will remain at £85,000 until the 31st of March 2024. The CGT annual exemption is going to remain at £12,300 for individuals and £6,150 for trusts. And this will remain in place until 2025-26. Likewise, the inheritance tax nil rate band will stay at £325,000 and the residential nil rate band will stay at £175,000 for the same period. The proposed increases to the income tax thresholds for 2021-22 will go ahead, so the personal allowance will be £12,570 and the higher rate threshold will increase to 50,270. These will then be frozen until 2025-26. Likewise, the national insurance upper earnings limit and upper profits limit will remain aligned to the higher rate threshold. Interestingly, the starting rate of savings remain at 5,000 for this year, but there wasn't any talk about that being frozen until 2025-26, so we'll have to see on that one. If any of our attendees are Scottish residents, then they just need to bear in mind that these rate changes will only apply to their savings and dividend income. The final real change was the lifetime allowance for pensions, which will remain at £1,073,100, as the link to the CPI has now been removed. The good news for us is alcohol and fuel duties have also remained frozen, but for any smokers out there, tobacco duty has been increased by 2% inflation. And just to finish this section on a very different theme, my last point is with respect to the introduction of financial institution notices from the 1st of April. So these notices will allow HMRC to request information on taxpayers from financial institutions in order to check their tax position and for debt collection purposes, without the need for approval from the tribunal. The whole purpose of this is to speed up the process of obtaining third-party financial information from the current 12 months to 6 months. This will bring the UK in line with other G20 countries. There are a few taxpayer protections within the provisions, so the information has to be reasonably required, and HMRC also needs to tell the taxpayer why the info is needed. If the HMRC don't want to do this, they'll have to go to the tribunals as normal. Okay, and then it's back to Andrew.
Thank you, Adele. It's interesting because the Chancellor's had his hands tied slightly due to the Conservatives saying they were not going to raise income tax, national insurance or VAT in the Parliament. Now, the fiscal drag of freezing all these allowances is actually very significant. So it's like increasing income tax in reality, and it raises quite a lot of money. There's one question being put up from one of our supporters, Exeter Chamber. They would like you to take a free question poll, what you think about the budget. So please, if you see it there, go through the link, answer the questions. It'd be interesting for them and us to see what you think. So our last section, we're now outside the EU. So Chris, international, what's happened there?
Thanks, Andrew. Well, yesterday's announcements and measures were a real collision of an investment-led recovery requirement and the impacts of leaving the European Union, as you've alluded to. Just taking a step back for context, we now have about 2.1 billion of government debt. The Exchequer estimate that in the fiscal year 21 to 22, we will pay interest of 45 billion to service that debt. It's been estimated that if interest goes up on that debt by just 1%, it will wipe out all of the tax we'll raise under the corporate tax measures that Mark took us through earlier. So international trade is essential. If we export, it's the loan that doesn't have to be paid back for an economy. Moving money around the economy with an international edge is hopefully the way we'll drive more GDP and then more tax. So what did we see yesterday? Well, one of the big announcements was the formal conclusion of the Freeport arrangements, with a number of locations announced and agreed as Freeports. And in the Bishop Fleming patch, we've got two. We've got Plymouth and South Devon and East Midlands Airport. What's so good about a Freeport? It creates an ecosystem where if you locate your business there and you invest in that area, then you are going to benefit from building allowances at an enhanced rate of 10%, which could mean you attract tax relief for expenditure that would otherwise not attract a tax deduction. Enhanced capital allowances of 100%. So if you're unable to get into the super deduction for any reason, the enhanced capital allowance might come in there. And of course, these measures extend beyond when the super deduction is due to end. These measures for Freeports extend to September 26, with the exception of the potential employer's NI holiday, which could go as far out as 2031. There'll be full relief from stamp duty on the purchase of land property within the Freeport area. Business rates relief will apply. I've mentioned the employer's national insurance contributions, and then interestingly, we'll be creating a zone where there will be simplified customs procedures. The full details of that I don't have before me, but we are potentially looking at situations where you may be able to bring something into the country free of duty, process it, and then take it out again without any duty implications. So you avoid a duty cost drag on the business that you're running. So very, very positive. The planning point there is just think about where you're located. If you're about to set something up new, maybe just take some time out and think about exactly where you're going to locate that business. As we exit the EU, the multinational traders amongst you with multinational groups may not have given a second thought to the interest payments and the royalty payments that you may have been making to other connected companies from the UK to EU territories. Up to now, they would have enjoyed no withholding tax whatsoever. The standard withholding tax rate is 20%, but the interest and royalties directive in the EU mitigated that to 0%. That's no longer going to apply. So now, in order to reduce the rate of withholding tax on any interest and royalties that you pay cross-border, you will have to go back to the double tax agreement between either us and France or Germany, wherever it is, and see what relief that you will enjoy there. It's not the same for every country. Two other points there. For royalty payments, you can self-assess whether the treaty applies. For interest payments, in order to pay them gross, if the treaty enables you to do that, you have to get clearance from HMRC to do that first. A number of people won't be used to doing that and may get caught out. Visas, as you know, we are moving towards a point-based system. Freedom of movement of people has gone. The announcements yesterday and running up to yesterday are all around high-skilled migration. There's a number of measures that are designed to make it easier for UK employers to source key expertise, very much with a knowledge-intensive economy angle, to bring them into the UK, from elite points-based visas, global talent visas, through to the Global Entrepreneur Programme. So that's great. That certainly oils the wheels. But make sure you're planning ahead if you're resourcing from overseas, and be careful not to get trapped with the current lockdown regime. We've got a couple of businesses that have recruited people overseas. They were due to relocate to work for the UK company. They've been unable to relocate because of the COVID restrictions, but they have started working for their new UK employer, and as a result have triggered an overseas payroll tax obligation because they are an employee working overseas. So if you're about to recruit people, or you have recently recruited people and they're trapped overseas, be very, very careful. And then the next step on from that is that individual doing something in that country that might be triggering a permanent establishment, i.e. a mixture of COVID-19, the ability to move people, but not as a result of COVID-19, could mean you start to have tax exposures overseas, an unintended consequence of the fact pattern that you're evolving in your business. We've had an interesting discussion with a client recently on food business operators and the requirement, if you're within the EU, if you're selling into the EU, that your distributor has their labelling on your product in terms of address. Concerned that that might cause a permanent establishment if you're having to use a French distributor to sell into the French market. That won't trigger a permanent establishment. So any regulatory changes that are imposed upon you, that of itself will not trigger an overseas tax liability for you. But just be careful. If you evolve that relationship with your distributor so that they start to bind you into contracts as to who you're supplying with, on what terms, that could trigger an overseas permanent establishment and you find yourself having to register an entity overseas. And then just finally, there are some really nasty and detailed regulations around disclosure of cross-border transactions. The acronym was DAC6. I suspect many people watching this seminar have never heard of it. It's now, because we've left the EU, being taken out and being replaced with an OECD style scheme, the details of which we don't have yet. Why the OECD? Because the OECD drove the BEPS program, which was designed for countries to work together to avoid profit being moved to low tax jurisdictions that was at a mismatch to where that profit was actually being generated. So one of those was disclosure, but DAX 6 was born of that, but DAX 6 was an EU initiative. We'll have something that comes in that mirrors that. Your accountant and your professional advisors will be responsible for making those disclosures. So more complexity and issues to come. Andrew.
Thank you, Chris. Firstly, we've got a new record today. We've got 665 of you watching this webinar, which is the best we've had in the last year. So thank you all for tuning in. We'll now try and deal with some of your questions. Wendy, I think the first one I'd like to deal with is what's happened to the job retention bonus scheme.
Yeah, thanks, Andrew. You might remember that this was a bonus that was announced when it was thought that the furlough scheme was going to end, I think, at the end of December 2020. There was going to be a bonus payment to people who retained employees after the end of the furlough period. That was then cancelled when the furlough period was extended. And as far as I can see, it hasn't yet been reintroduced. It's possible that as we approach the end of the furlough arrangements again in September, that something else will be announced at that stage.
Thank you, Wendy. There is a second question actually on furlough, which I'll deal with, which is with furlough being extended until September, what measures are in place to ensure employees aren't delaying bringing back staff so they can have their wages covered by the government? Now, I think a couple of points on that one. One, hopefully, if you're reopening or increasing your trade, you'll need the people back. So I think the government's thought process on that is actually as businesses reopen and expand, they'll bring the employees back, and therefore that will reduce the furlough. There is a secondary point. No doubt a lot of businesses won't bring everybody back, and therefore they'll be able to keep employees they're not bringing back on furlough. And I think the third point I make on that is actually there's on furlough itself, HMRC are looking at these really carefully. They've got a specialist team that have actually already made a number of inquiries into furlough, and when they look at it, they look at it in real detail. So my warning to you on furlough is make sure you're abiding by the rules, make sure you've got all your documents, because if you get an inquiry, and I think quite a few people will, they really go into detail. Chris, just on the super deduction, there's quite a few questions about what items qualify. I don't know if you can, I know you covered it in your speech, but if you could perhaps expand a little bit on what will qualify or what we know will qualify.
So the way the legislation is written, it's plant and machinery unless it's excluded plant and machinery. So for instance, we had a question about a van. I saw that go through there. So cars are excluded, but the definition of cars doesn't include vans, so a van would qualify. You need to incur the expenditure on your trade, on plant and machinery, but not in a year that you discontinue that trade. That would be an exclusion. Ships, buildings, they wouldn't qualify. If you are buying assets to lease out on any form of leasing operation, that wouldn't qualify either. So actually, as a rule of thumb, it's the typical bits of kit that you buy to make stuff or drive stuff around, except cars.
Thank you, Chris. Wendy, and you might say you don't know the answer to this. Can retailers who are open claim the business rates holiday for the hospitality units that remain closed for the next few months? Wendy, you're on mute.
Sorry. Yes, I saw the question. I looked in the guidance and I'm afraid I can't see anything. The guidance is extremely thin in this area, so I think possibly we'll have to wait for some more detail to come out on that.
Okay, thank you, Wendy. Chris, there is a question. I mean, obviously Plymouth is actually in the region, in our region. The question is, where can people find more information on the free pool? I don't know if anything's been published yet, or where it will go when it is.
Gov.uk has got a lot of information about that. There is still some T's to be crossed and I's to be dotted before the areas can be formally designated. So the full details are not yet known. And I can see another question there about how far do they extend. There has to be a limit on how far they extend because of the customs element, the customs free zone element of it. But there is talk about possible extensions to the geographic area, but we don't know anything about that yet. So I can't give a definitive answer on either the exact territorial limits or whether they might be extended.
Thank you, Chris. Wendy, I think you covered this, but actually there's a question there, and it's quite important. It's probably worth making sure everybody understands. And that's with regard to the deferred VAT. The question is, are you saying even though companies have been given time to pay, they have to get it formally agreed before the end of June?
Yes, basically the 5% penalty I mentioned will apply to any VAT that's outstanding on the 30th of June where you haven't agreed a payment plan of some kind with HMRC. So if you might not have paid everything, but you have to have agreed with HMRC what your instalment payments are going to be to cover that outstanding balance. So if you've just left it and not done anything, then you will get that 5% penalty.
Thank you, Wendy. So it is really important to make sure you have agreed it.
Yeah.
I think the last question I'll deal with, there's quite a few questions obviously about when will other taxes increase, and obviously we don't know. There is quite a bit of consultation out over things like wealth taxes and capital gains taxes. Interestingly, I think if you look at economics, the three big taxes that raise revenue are income tax, VAT and national insurance, and then corporation tax. A lot of the other taxes like capital gains are more political than they are actually revenue raisers. So I suspect if they're making changes to those, it's on political grounds rather than anything else. So probably next year's budget, I would suspect, if we're going to get it. And there was a related question, I think, on increases in taxes and would they affect the value of a business. Now, reality is most businesses, when they're being sold, they look at EBITDA, which is pre-tax, and they're looking at the prospects for the future. I wouldn't anticipate that any people buying the business are going to lower their offer just because corporation tax is going up. Well, thank you very much for everyone joining. Thank you all for your really interesting questions. I hope you enjoyed it. And if you've got more questions, and I know you will over the next few days, one, we will be publishing more detail as it comes out on our website, and two, obviously feel free to speak to anybody at Bishop Fleming who will hopefully help you with any questions you have. Thank you very much.